Brad Williams, Frugal Finance. What is value investing? Buy what others miss. Most people buy stocks the way they buy headlines, quickly, emotionally, and often at the worst possible time. Value investing flips this idea. It's not about hype, it's about hunting for quality that's hiding in plain sight. When a great business gets unfairly punished by the market, its stock may fall well below its true worth. That gap, that opportunity, value investors don't chase fads. They wait, assess, and strike when others flee. Today, we'll explore how this patience, deliberate approach has stood the test of time and learn what it takes to build wealth by buying smart when the price is wrong, but the fundamentals are right. What is value investing? Value investing means buying a stock for less than its actual worth. The goal isn't to predict the next big thing. It's to find businesses the market is misjudging. Value investors believe that the stock market overreacts to short-term noise. Good news pumps prices too high, bad news pushes them too low. In the middle of that chaos are businesses quietly generating real profits. This strategy demands analysis of earnings, assets, and long-term potential. And because true value reveals itself slowly, these investors don't just buy and hold. They understand and wait. Visualize a simple bar layout. Current stock price versus estimated true value with margin of safety shaded in. The common trap. Many new investors confuse a low price with a good price. Just because a stock is cheap doesn't mean it's valuable. It might be cheap for a reason. Maybe the company's drowning in debt. Maybe its leadership can't execute. Value investing avoids this trap by focusing on why its stock is cheap. Is it temporary panic or permanent damage? The biggest mistake is thinking you've spotted a hidden gem when what you've really got is a falling knife. That's why experienced investors look for more than numbers. They look for business models, cash flow, and competitive advantages. Why patience pays. Value investing is not for the impatient. Imagine buying a dollar coin for 70 cents and then waiting 2 years before anyone else notices. That's how it works. The market won't congratulate you quickly, but over time, fundamentals win. A company that grows earnings, keeps healthy margins, and rewards shareholders eventually commands its true value. And when that happens, the upside can be significant. The timeline isn't always smooth, but if you stick to your principles and ignore the noise, the results can compound in your favor. The intrinsic value lens. Value investors view stocks through the lens of intrinsic value. What a business is actually worth based on financials, not the latest headlines. They examine price to earnings ratio, free cash flow, and return on equity to estimate true worth. Then they compare that to the market price. The bigger the gap, assuming solid fundamentals, the more attractive the opportunity. Think of it as buying dollar bills for 60 or 70 cents. This mental model keeps emotions out of investing. It's not about liking a brand, it's about trusting the math. The margin of safety. Even the smartest analysis can be wrong. That's why value investors insist on a margin of safety, a buffer that protects them from overestimating a stock's worth. It means buying well below intrinsic value, not just slightly below. Benjamin Graham likened it to building a bridge that can carry 30-ton trucks, even though it usually only carries 10-ton ones. It's not pessimism, it's protection. This safety margin shields you from your downside risk and gives room for upside surprise. Connecting the dots. So here's the system. Estimate intrinsic value with discipline. Identify misvalued stocks. Demand a margin of safety. Wait patiently for recognition and don't get shaken by volatility. Every price matters. This isn't guesswork. It's a repeatable framework that favors data over drama. When you understand why the market misjudges value, you stop being a passive trader and start being a strategic owner. Think long, act wise. Market rewards clarity, not speed. Value investing invites you to zoom out. Think in years, not weeks. It's not glamorous. You won't win cocktail party arguments about the hottest stock, but behind the scenes, value investors quietly build wealth. Their strategy isn't based on trends, but truths. Businesses are worth more than their stock prices suggest. And when prices catch up to value, the patient prospers. Remember this, you don't need to predict the future, you just need to buy it on sale. Are you an intrinsic value investor? Are you a momentum investor? Are you just shooting from the hips? Pass on your tips. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.